I have hit the big red button today. I'm joined by Nic Carter. Excited to talk about his recent piece. What's going on, Nick? It's been a little while since our last chat.
I'm very glad to be back, Luke. Thanks for having me on again.
Last time we spoke, it was about Satoshi potentially moving his coins. Those seem like simpler times.
Yeah, the scandal of the day.
Yeah.
Yeah, I know. Things are a lot more complex and difficult these days.
Was Satoshi moving his coins, or Satoshi not moving his coins? It turns out it wasn't Satoshi. That was pre-COVID, right? Feels like pre-COVID.
It might have been. Yeah, it might have been. I honestly don't remember. But yeah, that was like the big excitement in the crypto industry.
That was the shock. That was the worry of downside. What's life like, man? Are you still having to jog with a mask? I know that was pretty brutal last time we talked.
Yeah, so I was complaining about that. So I am now complying with the letter of the law and not the spirit of the law. So any of you narcs out there that want to report me, I have in my possession certain masks that are like fake masks. So they're like, there's like a mesh which is very breathable. Obviously, it's not suitable for, keeping viral particles from spreading or whatever. But so yeah, I have a fake mask that I use for running now. It's great.
I won't tell anyone.
Yeah, I hope nobody watches the stream. But I mean, like honestly, like runners are the people that are the least likely to have COVID, because if you have COVID, you're probably not going for your daily 10K run.
Right.
So I feel kind of okay about it.
I think everyone's starting to feel more okay. The one thing that hasn't changed, and I don't know if it'll ever change, I don't know if I'll ever get used to it either, is the violence of the market cycles in crypto, especially for alts. I mean, in 2017, 2018, I was like, it's probably the last time we're going to have this ridiculous parabolic move where we see, this year for DeFi, 40%, 50%, 150% were June, July, August. That was the returns for most DeFi assets. Now we have like an 80 or 90% drop, and the system is unwinding. And a lot of people use TA when they're looking at that move. I'm included. I like to use TA, and they say if price goes above this level, we break higher. If price goes below this level, we break lower. You just published a piece that someone said, this is the real TA. This isn't the charts. This is the real TA. I want to break that down. Do you think that's the real TA? What are your thoughts on TA compared to this?
Well, I've never been TA adherent. Honestly, I'm not a trader. I'll make a few trades a year kind of thing. So I don't really have a stance on TA. I know, my trader friends, they have heuristics that they rely on. And like my view is that TA is like a kind of condensed set of heuristics which have to do with psychology, and totally accept that that's valid, although I obviously don't over-index on it and don't use it for my own purposes. But yeah, the implications of the piece do have to do with price. That's always the challenge, is to try and connect on-chain behavior and activity to the underlying pricing of these networks, and it's usually really inefficient and very difficult to connect the two. But I think in this case, there's some kind of strong evidence for my hypothesis here. And the other interesting thing is that now that I publish this, we'll see, because I'm making kind of a fairly testable prediction as well. So over the coming months, we'll see if there's any legs to my theory.
We'll hop back on and talk about it. Let's talk about your theory today, though. This is something that you noticed with market cycles with Bitcoin first, but more specifically, you're looking at transactions and then the fee market, how fees build up. And there's a negative feedback loop. And you first noticed this with Bitcoin a few years ago, which led to your hypothesis and what we're looking at with ETH's price today. What was the finding with Bitcoin that led to this? How does Bitcoin work here?
Yeah, so obviously when Bitcoin gets full, the fees rise as people compete for the space in those blocks. So we all kind of knew that. But in 2017, everybody was looking at the fee chart in dollar terms. And what they saw was one big spike, because you had the effective fees and then you also had the effective Bitcoin USD going up a lot. And so it looked like a single big spike in fees. But that actually wasn't the true story, or it wasn't the whole story. If you looked at the fees in Bitcoin terms, they were spiking and oscillating, 6 times really over late 2017, or the entirety of 2017 and early 2018. So there was actually a sustained oscillation in fees in Bitcoin terms over that year. And I realized that was actually correlating with transaction count. So transactions were leading fees with a latency of 1 to 2 weeks. So the blocks would get full, fees would lag that, and then the fees would catalyze less usage because people would basically get sick of it. And then with a latency or kind of refractory period of about 2 months, the cycle would begin again. So there would have to be a period where transactors kind of forgot about the high fees. This is kind of like my really weak psychological hypothesis or something, but maybe people reach this fee exhaustion, and then it would take them 2 months to kind of mentally reset and become amenable to transacting on chain again. But so regardless of the reason, we saw 6 of these whole cycles play out in 2017 in Bitcoin. Fees and transactions co-moving with latency like a sine wave. And when the fee, I don't know if you want to call it a crisis, or fees started to really expand on Ethereum this year, I thought to myself, oh, but I bet we're going to see the same thing again. And if so, what are the implications of that? And is the presence of much more on-chain liquidity on Ethereum, is that an interesting factor, which might sort of maybe mean that this has much more severe implications potentially?
Sure. So step by step, transactions fill up for Bitcoin transactions, fees get higher. People that are transacting feel that effect, and either they have to reset or fees have to come down before they're comfortable with transacting that much again. Could you, before we go to Ethereum,
exactly,
is there a direct relationship that you saw with this oscillation, with this cycle happening every 2 months? Was price doing anything? Was price lagging this? Is price leading this? Or was it really hard to kind of draw that?
Bitcoin's price was kind of indifferent to it. In 2017, it was just this like slow parabola starting in March, and then obviously, hitting 19, 20,000 in December. And so there was no noticeable correlation between Bitcoin price and fees or block fullness or anything like that. And so that's why I pointed this out back in 2017, and people didn't really care. They're like, okay, so what? And maybe that was the right reaction. And I think the reason for that was people would transact, they would get exposure to Bitcoin on centralized exchanges. You send an ACH transfer, you send a wire to get to the exchange, you can buy Bitcoin, you're buying an IOU. You never really touch the chain unless you want to withdraw it and send it somewhere else. So you can transact with Bitcoin in this sort of intermediated way, and never, have to do a blockchain transaction if you don't want to. Now, with Ethereum today, it's a little bit different. A much higher percentage of those transactions are hitting the chain because Ethereum itself is like a gigantic DEX. That's kind of the point of it. And so that's maybe the difference between, Bitcoin back then and then Ethereum today.
So the difference, everyone can see that centralized exchanges playing a larger role for Bitcoin, but the comparison of this fee negative feedback loop is almost the same for ETH, correct? We're seeing fees rise, people get priced out, and then there's a feedback loop, and now we have a cycle. So that was your observation. You thought that could happen. Is that what you saw in the data?
Yeah, and I'd love to fast forward a year and see if I was right. But so what happened was fees rose to pretty eye-watering levels, honestly. Yeah. I mean, we were talking about deploying an Aragon contract was in the hundreds of dollars to do that. And, simple DeFi transactions that are more gas intensive than just sending ETH, were $50 kind of thing. And there was I believe it was September 2 was the average or median transaction on Ethereum of any sort was in the double digits, which is really significant for Ethereum because Ethereum produces a lot of block space. And so transactions and fees, they rose at the same time. Let me pull up the chart from the article. The transactions, like with Bitcoin, they peaked ahead of fees. So as the fees kept climbing, that was a drag on kind of transactional activity. And the fee peak was early September. At that point, transactions had already begun to decline. So we saw the same effect, and I'd be interested to see what that cycle length is like, if it's this 2 months that we saw with Bitcoin, if it's shorter, if it's longer. But regardless, I mean, talk to people that are really heavy consumers of DeFi, a lot of them deferred their transactions. They stopped being as active, especially if they had a smaller bankroll. I mean, you have to manage that fee overhead relative to the size of your bankroll. So you can sort of know intuitively that people stop transacting a little bit from fees, or you can also look at the data. And I assembled a lot of that data in this article to kind of demonstrate that as well.
One thing I saw constantly on Twitter, and this wasn't ETH haters, these were people that were deep into DeFi, heavy users, or they were the random person trying to ape into a Uniswap coin and make, a 10x or a 5x and just kind of degen into a trade. All of a sudden they started saying, man, these fees are too insane. Like if I don't have a $10,000, $50,000, whatever it is roll, maybe I shouldn't be trading on Uniswap. Like that was a real consideration that I would see on my timeline all day.
Absolutely. And one of the most interesting things that I found, and this was a discovery where I was like punching the air and like saying Eureka, was like when I realized that transaction size, like your average transaction, was correlating really tightly with average fees. And to me, that demonstrates that most transactors have like a mental threshold in their mind of the amount of loss they're willing to take on fees per transaction. It's a percent of the size of the transaction, and it's heterogeneous. It's different for each person, but in the aggregate, what it means is that you get this really tight correlation between average transaction size and average fees. And so I think that totally bears out what you're discussing is, some users will obviously take a very heavy fee hit if they perceive that there's an amazing opportunity on some new token that just launched, or if they really want to exit a certain pool or something like that. But in the aggregate, people are pretty sensitive to fees, and it's borne out in the data.
So can we directly tie price to this? With Bitcoin, we couldn't. With ETH, it actually did top out in early September, and that's when fees were insane. That's when the timeline was full. It's when people were all about Uniswap. DeFi obviously still going quite crazy, but then price did top. Is that a coincidence, or is this maybe a hint that ETH is, there's a more direct tie to DeFi leverage, DeFi activity, and ETH's price?
Yeah, so and keep in mind, when I talk about fees, I'm talking about the main metric I use is median fees in ETH terms. So obviously, fees in dollar terms are going to correlate with ETH price. That's not like a profound realization. But I'm talking about fees in ETH terms correlating with the price of ETH in dollar terms, which is much more interesting. And so, yeah, I mean, so they did correlate. ETH's ETHUSD, its local peak was September 1st, maybe September 2nd, and the peak for fees was in that same first week of September. It was a little bit spiky because there was the Uniswap launching, which is like one of the most congested days of activity on the Ethereum blockchain in its history. So there was Curve launching, SushiSwap had its kind of explosive growth. And so it's a little spiky. So there's no single day where I could say, okay, this is really the peak for fees, but they absolutely did co-move, and they've been coming down together over the last month. And so maybe it's a coincidence, but I think they're related.
But as I think about correlation is so tough because you never know if it's causation. You have to kind of think about what the cause and effect is. And if you mix those two up, you get in a bad spot pretty quick. From a conceptual standpoint, if you brought up liquidity and how fees could affect that. So, using the traders that were on Uniswap as an example, less people start trading on Uniswap because they're priced out. All of a sudden, there's less liquidity on Uniswap, meaning those assets, if people want to sell or if they want to get out or just new buyers coming in, all that starts to dwindle. All that starts to decline a little bit. So it would at least seem that this is there's a higher chance this isn't a coincidence. Is kind of what your article is at, I think.
Yeah, and like, to be fair, I'm making some like conceptual leaps and certain inferences, and relying on analogies from other games that I'm familiar with. Like I make an extended poker analogy in the article, which actually is like the way I talk about rakes is not how they work at all. But the point is to develop an intuition for why increasing, the requirements for bankroll sizes might decrease liquidity overall. And I think it's pretty straightforward. I mean, if you're kind of kneecapping that lower quintile of the market, they're going to stop transacting. That means the opportunities are worse for even the sophisticated traders that are maybe trading against those less sophisticated kind of retail entities. And just generally, like a degradation of liquidity, I think affects Ethereum because Ethereum is the base pair that trades against all of these things.
Yep.
It's the reserve asset for DeFi. That's why everybody looks at these total value locked metrics. The total value lock element is a pro-cyclical force. We saw the exact same thing with ICOs. I didn't mention this in the article, but that's another thing that gave me confidence in this point. When the ICOs, they acted as this inducement to lock up a large quantity of ETH, and then over 2018, they kind of spat out that ETH as they had to spend on salaries and so on, and they had to spend more and more as the unit price dropped. Same thing with DeFi. ETH is that base collateral. It's the trustless collateral. It's no one's liability. That's why it makes for good collateral. And it was sucked up by a huge number of DeFi projects. And then, that meant that there was just fundamentally less ETH available to the market, which obviously has a positive effect on price, all other things equal. But then when they disgorge that ETH on the other side, that's when it potentially puts pressure on the unit price. So to the extent that these DeFi products, lending and swapping, and pooling products and interest rate swaps, they became less popular, which if you look at the last few weeks, really the last month or so, their usage has waned a fair amount. My guess is that, that's related to the pressure on the price of Ethereum.
I want to flesh out your poker analogy because this actually made something else click for me, and it's probably going to affect how I think about things like Uniswap in the next cycle if DeFi assets do make a rebound, and I think it'll also help other people. I think the analogy, even if the rake thing doesn't exactly make sense, I think it's really good because it talks about the type of players that would be at that poker table and also the type of people that are going to be trading on DEXs, and it affects how alts are going to perform. It affects how ETH is going to perform. So your poker example, basically think of ETH and the ecosystem, DeFi, the DeFi games people play, whether that's yield farming, whether that's on a DEX, is very similar to a private game of poker. And at a poker game, you have the best players in the world, you have some semi-pros, you have some fish, some people that just like to gamble and lose a lot of money. What kind of elaborate on that analogy, because I really liked it, and I think it'll help people think about who they are when they're trading on Uniswap.
So this analogy is actually, this is really the thesis of adaptive markets, which is this kind of hypothesis developed by this guy Andrew Lo, which I highly recommend that anyone read. It's a great book. There's a shortened version, essay form, but so this is my condensed version of the adaptive markets hypothesis, basically. And so, as you say, the key insight is realizing that market participants is heterogeneous and they have different behavior styles. And anybody that was active on internet poker kind of in the early 2000s knows this. I mean, it was very fertile grounds early on when retail was really, really active. And then later on, as it became more difficult for retail players to get access to those venues, with regulations, and as a lot of those retail individuals just lost their bankrolls over time, the games got much more competitive as you just had the grinders playing against each other. And it's that same intuition. And then you actually saw the same thing repeat in the daily fantasy games, they like the DraftKings, FanDuel kind of thing. Initially, there were a lot of retail punters, which meant there was extremely fertile hunting ground for professionals. And then the whole space professionalized, became more challenging. So the analogy here is that, you're sitting down at a poker table. You want to sit down when there's a rich amount of liquidity, and in particular, the liquidity is in the hands of like the less sophisticated individuals. That's when you want to be playing the game.
The degens.
So that you want to sit down at the casino on a Friday night. You don't want to sit at the casino on a Tuesday morning, and play against the grinders.
Sure.
So and then I talk about the rake being equivalent to the fees. If you raise the rake, you're going to be pricing a lot of that. A lot of the aggregate liquidity is controlled by smaller users, and if you price them out, there's less kind of degen liquidity floating around, and the opportunities get worse for everyone. and those semi-pros or pros are maybe less inclined to be active there because they're intuitively making this table selection idea, and they know where they want to be trading.
Because the degens are no longer there. They get priced out, the rake's higher, and as the worst players leave, now it's just the best players in the world that are going to keep playing because it's the game they're good at. And now it's when it's a pro playing against a pro, not only is it not as fun, but you're not going to make as much money. And it's the same thing that's happening on DeFi. As people get priced out, well, a lot of that liquidity and a lot of that flow that was really attractive for the pro to sit down, all of a sudden it's now a pro versus another pro.
Yeah, the pros are still there, but they're just, as you say, they're not having as much fun.
Yeah. So no one's having as much fun when liquidity drops, when price drops, the game just simply gets tougher.
But there's good news, which is that this is cyclical, in my opinion. And so in maybe 6 weeks from now, I mean, we've already had about a month worth of drawdown. The fee peak was more recent than that. Transactions have been falling for about a month. As block space becomes less utilized, as enthusiasm dims, eventually it's going to become cheaper to transact, and maybe new use cases are going to be developed that are more attractive with the now cheaper block space. So it could well be the case that in 4 weeks time or 6 weeks time, there's a new kind of wave of enthusiasm driven by this now cheap block space, and the cycle begins all over again. Now, there might be a kind of a longer term secular disenchantment with DeFi, which might mean that the cycle is longer. That's honestly what I expect. But if we see the same cycle length that we saw in Bitcoin, then you would expect about a 2-month latency.
So yeah, it's not as clear yet if the ETH cycle is going to be the same time frame as Bitcoin's. And as you said, there's more market factors and things that could kind of impact when that rises again. But if the fees do drop and if fish can return to the table, then the game gets more fun for everyone. One thing that's maybe holding us back, and I don't want to go too deep into this and lose people because I'll even lose myself when we start talking about ETH scaling, but is this going to be something we're talking about all the way through 2021? You mentioned rollups in your article. You mentioned a couple other scaling solutions. I was just listening to Olaf on Laura Shin's show, and he said teams are actually looking at other projects. And Olaf's a big believer in ETH, right? These aren't just people that are trying to FUD ETH. This is still a real consideration that people have to have. Are we still going to be talking about this? Are we going to have to keep going through the cycle, or will we eventually reach a point in 2021 where maybe the cycle gets shorter? The fish don't have to leave the table. What do you think?
Yeah. So, I mean, to be clear, I think having lots of fees on the base layer blockchain is a great thing. So this isn't me fudding the fees on ETH or anything. I think fees are great for Bitcoin. I think they're great for Ethereum. What they allow you is to have that scarcity. In Ethereum, of course, they're going to try and use fees to burn ETH in the future. And then in Bitcoin, the fees allow you to have that cap supply. So I'm totally pro fees. I just wanted to point out, some of the externalities of fees and how they look in the wild. But there are, as you say, a few factors which could attenuate this cycle. So one is Ethereum can produce more block space. The miners habitually increase the gas limit. They could do that again. I wouldn't recommend doing that, but they could because it makes running a full node more difficult. The other thing is there's now alternative block space being provided by chains that are similar to Ethereum, or they have the Ethereum 2.0 template. So now there's a whole bunch of competitors. I'm not that bullish necessarily on DeFi liquidity migrating to alternatives because it's such a network effect driven thing, and the ecosystem of tokens that exists on Ethereum is what makes it worthwhile, basically. It's all about the assets that you can trade and get leverage on, and those are all on Ethereum. So I don't necessarily see that as a catalyst. I just think it would be much more challenging because you'd have to replicate not only the infrastructure but the applications, right? There's two things happening here. There's the infrastructure to trade things, and then there's the things you want to trade.
Yep.
So any challenger to Ethereum has to accomplish both of those things. The infrastructure is maybe easier. They can clone DeFi processes, but can they really accumulate, get the liquidity, get all of these tokens, stable coins, et cetera, over there? That's more challenging. So I'm actually not that bullish on alternative block space being, a viable competitor there. The other thing that is more complex would be these scaling solutions like rollups, which I know you told me before the call you didn't want to talk about because it's too complicated.
We can talk about them, but you'll lose me, and I know you'll lose some of the audience.
I mean, I probably spent 10 to 20 hours trying to figure them out for myself over the last week. But I knew that if I wrote the article and I didn't address it, all the Ethereums would be like, Nick, you didn't do your research. This is garbage. Bitcoiners can't write about Ethereum. So I had to prove to them that I was willing to put in the work.
Respect.
And my conclusion from all that is that rollups are honestly pretty interesting scaling technology, and we should try and do them on Bitcoin as well. But I also felt that it would be difficult to have composability if you roll-up-ized a bunch of DeFi applications, because there's something really special about using this asset that settles finally on every single transaction in this composable framework. That's really what makes it work. The fact that each settlement is not in doubt, each settlement of a token or a settlement of Ether, that's final every single time. And that's what allows you to build these intricate interlinking systems that don't have these, potential cascades of risk. If you introduce settlement risk into that framework, it becomes a lot more complicated. So I think that Ethereum is actually liable to have this fee oscillation for a while. That's basically the point.
But as you said, that's good news, because maybe in 6 weeks, maybe in 2 months, we'll be talking again, and the game will be fun again, not just for the pros, but for everyone. That would actually be really fun to talk again when ETH's on one of these euphoric rises, and we can kind of look at how the fee market's doing, where the oscillation is, and if things are still lining up. Let's
and
go ahead.
The interesting thing is that, unlike with Bitcoin, this maybe has implications for the price of ETH. So maybe it has tradable implications. Now, the fact that I've written the article and I came on this podcast and said it means that the alpha is maybe going to degrade a little bit, because people are going to try and trade against the idea if it's a viable idea. So that's kind of, whenever you point something out, obviously it stops being as useful a signal. But I don't think that many people have read it yet. So maybe there's still some opportunities there.
You made a noble sacrifice coming on here and leaking some alpha. We appreciate it.
I wasn't really trading against this, although on my podcast on September 2nd, I said, I think fees are high. I think DeFi leverage is going to unwind. So I'm on record, making that call, not to pound my chest or anything. But yeah, I mean, understanding Ethereum is all about understanding these cycles of ETH being locked up, inserted into DeFi, and then trying to figure out when it's going to be spit out the other side. That's kind of my view on the main, price drivers for Ether right now.
Well, I'm gonna be watching it. Hopefully too many people don't. I've never said that about a show. I don't want that many people to listen to it. But for those of you who are listening, hope you guys enjoyed it. Please check out Nic's article. I'm gonna link it down below. If you're watching this on YouTube, you can hit the link. Highly recommend it. It's actually, some articles that you and Coinmetrics team put out, I love them, but some of the scaling stuff, as I said, is just a little bit intimidating. This one's really manageable, and if you are tracking DeFi, I think it's important to watch. On a more important note, Nic, are you playing in the poker game tonight? Is it going to be an easy game or a tough game?
Oh, I have a bunch of obligations. I have to write a chapter of a book, so I can't, unfortunately. But yeah, I mean, using my theory, you want me in that game. So
I don't know. The only couple hands I've played with you, I remember, is the Jack. I can't forget that one.
Yeah. Well,
it's
that ace Jack against Jacks or something?
I was the degen in that situation, and yeah, I gave you some sats, man. But it was worth it.
It's a good game.
It was worth it. Anyways, Nic, appreciate you coming on. For everyone else listening, thank you guys for stopping by. That's all we got. I'll see you in the next episode. Thanks, Nic.